in our LinkedIn Live on this Saturday afternoon. This is 𝗨𝘂𝗶𝗃𝗂𝗧, founder and managing partner at taxmantra global. And I've got my team member Yogesh from our tax team. So today, this LinkedIn Live is very, very important because we are going deep into a discussion which is very relevant for Indian founders who are going global. And in this LinkedIn webinar, we will embark on a deep dive journey and we will understand the nuances of capital gain taxation under India-Singapore Tax Treaty. And the discussion is particularly relevant against the backdrop of robust economic ties between India and Singapore, and as many Indian founders looking to expand globally via setting up their entities in Singapore. Few points about India-Singapore, which is very, very important to understand. So India's economic surge in the last 10 to 15 years with its vast market and burgeoning startup ecosystem is projected to be world's third largest economy by 2030. The country has just passed 4 trillion mark last week, and the country is witnessing a significant rise in FDI with record inflow of 81.72 billion in the fiscal year 2021. Out of that, close to 39 billion came in only into startup ecosystem. Its tech startup scene is booming with over 50 unicorn, which became unicorn in that year itself, showcasing a diverse range of innovations from fintech to e-commerce. On the other hand, Singapore's strategic position, Singapore is known for its robust economy and ease of doing business. It serves as a gateway to ASEAN region. It is a global financial hub with strong emphasis on tech innovation and supportive ecosystem for startups. In 2021, Singapore attracted 11.8 billion in fixed assets investments, reflecting its status as a preferred location for business expansion into Asia. In fact, due to the geopolitical reasons in COVID, post-COVID, Singapore has become the most important financial center in Southeast Asia and Asia, with people using Singapore as the anchor country to invest into India and globally. Singapore has emerged as a leading source of foreign direct investment into India. Now, this is very important, and you will be surprised to know that almost 23% of the total FDI which comes into India for the last 2 decades, which has come through Singapore. In the fiscal year 2023 alone, which is the current year, FDI flow from Singapore to India is estimated at $17 billion. This reflects a strong and growing economic relationship with total investment of approximately 140.98 billion over the last period. In the realms of startups and innovation, India has shown remarkable growth, becoming the world's third largest startup economy. As of October 2023, India is home to 111 unicorns with total valuation close to $350 billion. The year 2021, as I was saying, was particularly significant with 45 plus unicorns emerging in that year itself. On the other hand, Singapore has got its own vibrant ecosystem, which has 14 unicorns, which is from diverse industries and innovation. This not only underlines Singapore's role as hub for startups in ASEAN and in Southeast Asia and also in Asia, but also a strategic importance in Asian economic landscape. As we delve into our main topic, which is understanding the tax implication of these economic activities, it becomes very important. The India-Singapore Tax Treaty plays a significant role in shaping the tax obligation of companies and investors operating across borders as far as the capital gain is concerned. Our session today will unravel these complexities and provide insights into how businesses and investors can navigate this landscape. So let's begin our journey to explore this capital gain issues, taxation within the context of vibrant India-Singapore economic partnership, and understand its implication of businesses and investors in both the countries. So with this, I invite Yogesh from my team to take it forward and start this discussion on capital gain taxation, its ambit within the ambit of tax treaties, and also in Singapore, India, recent amendment which has come in, which has become very important. So over to you, Yogesh.
Thank you, sir. And good afternoon to our viewers for this session, which is on the capital gain. The amendment portion is covered. So this amendment was brought into picture in 2017 during the governance of late Mr. 𝗀𝘅𝘁𝗍𝗪, the former Prime Minister of India, the former Finance Minister of India, sorry. And this capital gain, this amendment has, addressed the base erosion profit shifting and the tax avoidance schemes adopted. And to a much extent, it has brought the parity between the resident of India, the tax implication, the capital gain tax implication on the resident of India, and the Singapore investor. So we'll start our slides with the, what was the scenario before pre-amendment, the reasons for the amendment, and the effect the amendment has brought. We'll also take into the scenario the taxability of the Singapore investors when they invest in India, and when the Indian investor invests in the Singapore, so the tax implications. So moving forward, so pre-amendment analysis, if we do about the capital gain, the DTA between India and Singapore, it was more of a residence rule than the source rule. So if a Singapore investor used to invest in India and there emerges to be a capital gain because of sale of immovable property located in India, or capital gain arising on shares of Indian company, or the movable property located in India. So the tax implication used to happen in the residence, which was the Singapore. While for the Indian investor who has invested in the Singapore, what used to happen if there emerges any capital gain because of immovable property, sale of immovable property located in Singapore, or maybe sale of shares of Singapore company, or maybe movable property in the Singapore. So the tax point used to be in India. So this was the pre-amendment. It was more of a source rule. It was more of a residence rule rather than of source rule. So what was the reason behind bringing the amendment is captured in this slide, which says that the pre-amendment tax point, the pre-amendment as per DTAA capital gain arising in India of the Singaporean investor were subject to taxability in Singapore and not in India. So the capital gain tax rate in Singapore used to be 0. So as a result, what used to happen, that the investments started coming through the route of Singapore, and 0 tax used to be, implied on such capital gain emerging on sale of shares or immovable property or movable property located in India. So the consequence of this result was this, that with such beneficial tax rates, many shell companies started investing in India via Singapore route, thereby resulting in base erosion and profit shifting, and brought revenue losses to the income tax department. So this was the consequence of pre-amendment. Moving forward to the next slide. So when the amendment was brought,
just go back to the slide once.
Sure.
So basically what Yogesh is suggesting is that this amendment happened sometime in 2017, right?
Correct.
Around GST time. So this amendment, prior to this amendment, because we all know that there is no capital gain in Singapore, there is 0 rated capital gain in Singapore, and there is no dividend tax also in Singapore. So this amendment, what had happened is that the taxes were levied on the basis of residency. So if the company is resident in Singapore, even if the company is investing into India and making profits from assets into India, since the company was situated in Singapore and there was 0 rated capital gain in Singapore, there was no taxation. And many founders and many people started incorporating companies in Singapore and started investing, right? Both in listed, unlisted shares, immovable property, lot of stuff, lot of assets. And because of that, there was a tax erosion, because the government realized that because of this, these companies are not paying taxes in India because there is no capital gain in Singapore, right? And the Singapore government also realized, because what has happened was that many businesses starting to invest from Singapore to India also. So when people started earlier the government was of the view that we will have equal people investing from India to Singapore also, and from Singapore to India also. But the government realized that no, many more people are investing from Singapore to India, because Singapore being the global hub, being the global financial hub, people in global VCs and global investors incorporate their entities there and invest. So this was the reason why this has happened. Yeah, over to you, Yogesh.
Absolutely, sir. So with the amendment was brought, and the effect of the amendment was that there was a parity in the taxation. So a resident of Singapore earning income from India is entitled to the same treatment of tax as an Indian resident earning income from India. So this was the first and the foremost advantage for bringing a parity between the Indian and the Singapore investors. And again, it was a source-based tax over the residence-based. Amendment has aligned India's objective, providing for source-based taxation of capital gain from sale of shares of a company to a resident in India. Then it has eroded the tax avoidance scheme. Since the capital gains taxability is now source-based, it will be governed by the Income Tax Act and may have the GAR implications when required. Thereby, to a great extent, it has addressed the issue of tax avoidance. And then this amendment has also restricted the incorporation of shell companies which are engaged in the base erosion of profit shifting and treaty abuse or round tripping of funds. Have to these companies have to rethink about their structure, as these amendments will address the issues related to the tax avoidance. So one more another advantage of this amendment was that it was so well designed that it was brought into the picture the prospective amendments rather than to go to the retrospective amendment. And there was sunset clause also into this amendment, which we'll check in the next slides. So this was the effect of the amendment.
Right.
So in this slide, we will learn how the post amendment has affected the Singapore investors investing in India. So if a capital gain arises to a Singapore investors on an immovable property located in India, like house or office premises, land, etc. So if the property is located in India, then such capital gain will arise in India post amendment. Since capital gain is arising, then we have to classify the capital gain into long term or short term. So if the period of holding is more than 2 years, it would be long term, and the tax rate would be 20% with indexation. And if it's less than 2 years, then it will be classified as short term and slab rate would apply. Likewise, for the capital gain on movable property like car, machinery, etc. So if the movable property is located of the permanent establishment located in India, then capital gain will arise in India. Again, we have to classify that capital gain into long term or short term, for which the period of holding plays a crucial role. In this case, it will be more than 3 years. Then the capital gain would be classified as long term, and the tax rate would be 20% with indexation. And if it's less than 3 years, then it will be classified as short term, and the slab rate would apply. Now, the next capital gain is on the ship aircraft operated in international traffic. In this perspective, still it's the residence rules rather than the source-based rule. So if such aircraft or ship is sold in India, capital gain will arise in the Singapore. So capital gain tax rate in Singapore is 0%. Next is for Singapore, again, continuing with the last example, that a Singapore investor has invested.
I think this is very important, because many of the founders, Indian founders, invest into Singapore, incorporate companies in Singapore, and now many of the companies in Singapore or global investors or global businesses setting up their anchor entity in Singapore and investing into India. This becomes very, very important. Yeah.
Absolutely, sir. This slide touches on the shares investment, the capital gain arising on the sale of shares of Indian company. So a grandfather effect has been given for shares which has been acquired before April 1, 2017. So shares acquired in India will be taxable still in the Singapore subject to LOB rule. Capital gain tax rate in Singapore is 0%, so no tax payable in India. So this particular, instance has been given the grandfather effect. The government says that if if a Singapore investor has invested in Indian companies and the shares were acquired pre April 2017, then that will be grandfather. No tax has to be paid in India. The capital gain tax would be payable in Singapore, which is 0% still. Now, after April 1, 2017 till March 31st, 2019, a sunset clause has been brought into the picture. So for these transactions, capital gain will be taxable in India, but the tax rates will be 50% of the applicable tax rates prevailing in those years. So suppose if 15% was the tax rate during those particular period, so it will be 7.5% leviable in India. And for the shares that has been acquired after April 2017 and sold after 31st March 2019, taxability will arise in India at the rates as shown in the below table. So it will be equivalent role. For the listed shares, again, we are going to classify the capital gain into long term and short term. If it's more than 1 year, it will be classified as long term, and the tax rate would be exempt up to rupees 1 lakh and more than 1 lakh 10% with indexation. If it's less than 1 year, then it will be classified as short term, and 15% without indexation, the tax rate would be applicable for the listed shares. Now coming to the unlisted shares part, the classification has been on the basis of the period of holding. So if the period of holding is more than 2 years, the tax rate would be 20% with indexation. And if the period of holding of shares is less than 2 years, then it will be short term and tax rate would be on the basis of the slab rate. So this was particular to the Singapore investors investing in the Indian companies' shares, or whether it's being listed shares or unlisted shares. Now, for the capital gain on property, other than discussed above, still the residence rule will apply. We can take example of compulsorily convertible debentures. Those kind of property may come into this picture. So the capital gain will be taxable in Singapore, and the capital gain tax rate in Singapore is 0%. So this was the discussion for the Singapore investors investing in India. Moving forward, for an Indian investor who is investing in Singapore, post-amendment, the capital gain on immovable property like house, office premises, etc. If the property is located in Singapore, then such capital gain will arise in Singapore. Capital gain tax rate in Singapore is 0%. 0% tax would be applicable if such gains has not arisen due to trading. But Indian investors' capital gain will be taxable in India as a global income, as shown in the below table, which is again we have classified the capital gain as long term or short term. If it's more than 2 years, it will be classified as long term, and the tax rate would be 20% with indexation. And if it's less than 2 years, then it will be classified as short term, and the slab rate will apply. So for the next class of asset is the movable property. Again, if the movable property is of the permanent establishment located in Singapore, then the capital gain will arise in Singapore because it's source based. However, the capital gain tax rate in Singapore is 0%, but the Indian investors' capital gain will be taxable in India as a global income, as shown in this below table. So here the long term will be classified on the basis of again period of holding, which is more than 3 years, and 20% tax rate will be applicable. And if it's less than 3 years, then it will be classified as short term, and the slab rate will apply in this case. Moving forward, for the capital gain on ship aircraft operated in international traffic for an Indian investors in the Singapore, if such aircraft ship is sold in Singapore, capital gain will arise in India and is subject matter of taxation in India as a basis of residence rule in this case. And for the capital gain on sale of shares of Singapore company for shares acquired before April 1, 2017, shares acquired in Singapore will be taxable in India at below rates. For the listed shares, If it's more than 1 year, it will be classified as long-term exemption up to rupees 1 lakhs, and for more than 1 lakhs, 10% with indexation. And if the listed shares, if the capital gain arises on a listed shares which has a period of holding of less than 1 year, then it will be classified as short-term, and the tax rate would be 15%. For unlisted shares, if the period of holding is more than 2 years, it will be classified as long-term, and the tax rate would be 20%. And if it's less than, period of holding is less than 2 years, then it will be classified as short-term, and the tax rate would be based on the slab rate. Now, for shares acquired after April 1, 2017 and gains arising between April 2017 to March 2019. For these transactions, capital gain will be taxable in Singapore. Tax rate in Singapore is 0%. So for shares acquired after April 2017 and sold after 31st March 2019. So for these shares acquired in Singapore will be taxable in India at the rates shown in the below table. It is same as like, taxing the global income of the Indian investor in India. So the period of holding in this case would be, again, if it's more than 1 year, it will be classified as long term. The tax rate would be, exempt up to rupees 1 lakhs. For more than 1 lakh, 10% with indexation. If it's less than 1 year, it will be classified as short term, and the tax rate in that case would be 15%. For an unlisted shares, the period of holding changes as compared to the listed shares. Here, the period of holding is, if it's more than 2 years, it will be classified as long term. The tax rate also changes, it becomes 20%. And if the period of holding is less than 2 years, the capital gain would be classified as short term, and slab rate will apply. So for the capital gain on property other than we have discussed above, the capital gain will be taxable in India on the basis of residence rule.
No, I think that this works well. We can move ahead.
This ends the discussion on the investors investing from Singapore to India, or the Indian investors investing in the Singapore.
Right. So I think
Perspective to the capital gain.
it was a very summarized and a very specific discussion which we had, and which was completely focusing on capital gain taxation between India and Singapore, both under India-Singapore tax treaty and under Indian laws. This became very important because India is the second largest. Indian founders are the second largest in terms of people who are registering in Singapore, and close to 40% of the total companies which are registered in Singapore are by Indian founders. Now, if that is the situation, then it becomes very important that we reach out and educate these founders in terms of what is the tax liability on the capital gain. As a firm, we have a comprehensive presence in Singapore since 2015, when we created our own presence, and we have 20+ people in Singapore, and we do complete setup, compliance, every services for companies and businesses who are in Singapore. And so please, happy to reach out to us if you require anything in Singapore in terms of setup in Singapore, or if you require any support in terms of your current structure, we'll happy to help. We are also partners with Singapore government authorities, and we help businesses to go and set up in Singapore, and also global businesses to come and set up in India. So I think this was very helpful, and thanks Yogesh for this, and thanks the Partly and team for setting up this webinar. And we will continue to do more such LinkedIn lives and webinars which are relevant topics, which helps founders to get education and get updated on global structures. And soon we will come up with more topics. Thanks everyone.
Thank you, sir.